Hello everyone, welcome back. Hope you've been well. Today we've got the bi-weekly portfolio update, and there's been quite a few updates to it as we've done a little bit of restructuring to the portfolio. So as per usual, we're going to see how the performance of the total portfolio has done. We're up roughly 11.8% combined year to date, and comparing that with a couple benchmarks of the S&P 500 and the S&P 900, we're currently beating the market so far. Couple things to note. Like I said, that is for the entire portfolio. The USD return is actually a better benchmark to compare to the S&P 500 and the 900. I should be comparing the Canadian portfolio to the S&P with TSX combination. So as I mentioned, because right now I only have the 900 and the 500, we'll take a look. So the 4.59% is the S&P 900, and what this is the 900 largest cap stocks in the US, and then we've got the 500. The reason why I have the 900 as well is because a lot of my companies that I have in the growth portfolio do actually include the probably I'd say mid-cap companies, and so the 500, if I only did the 500, it would be more of just a large cap companies growth. So as you can see, roughly on an average basis, we're doing a little bit better than 2x the market return. Now, this is a very short time period, so I wouldn't put too much, stock into these numbers. What's really important, or what's really of value, is if we are able to do this consistently year over year, right? If we can average a 5-year growth or a 10-year growth that is higher than the S&P 500 or the 900, that's where we're really kind of beating the market and getting better, value for ourselves, right? Historically, the S&P 500 is about 8%. So I was playing around with the compounding interest calculator. So if we started at 100,000, if we don't add any money into this at all, and we go purely by the interest rate, if I do an 8% interest, which is roughly the average return over the last, 50, 60 years of the S&P 500, we hit calculate, that gets us to about $1 million, right? So in 30 years, if we started with $100,000 at an average rate of 8%, which is basically if you buy the index fund, you can get roughly about $1 million. Now, if we're able to beat it by even just a little bit, 2% a year, right? If we do 10% instead of 8%, that number takes it up to $1.745 million instead of the $1 million mark. So you can see what I, chase after, or what my goals are, is really to just beat the market, just like everyone else. But I don't think it's important to really try and chase those, 20, 25, 30% annual returns. It's nice when that happens. And obviously the years that those happen, it'll be great. But on an average year-over-year basis, if you can just beat the market by a little bit, you're going to be doing completely fine for yourself. Now, if we go back to the portfolio, like I said, the US is a better indicator of comparing against the S&P 500 and 900. Next time, I'll likely have it split where I have the Canadian and the US tracked against the S&P TSX combination, as well as just the typical 500 and 900. For the graphs, you can see we're going up, and one important thing to note, I did make a $3,000 contribution into the Canadian portfolio. So that's a large factor for this increase up. There actually hasn't been too much appreciation on the Canadian side, although I am glad to see that if we take the 12,200 minus the 9,000 that I've put in, we are still getting some pretty decent growth there on an average annualized basis. The US one continues to do well. This week was a bit of a choppier week for the market, and we did actually take some hits earlier on in the week, but Friday kind of helped it come back a little bit. So going over the portfolio restructuring, the main reason why I felt it was necessary was because it felt like the portfolio was straying away from some of the values that I have when it's being constructed. Some of the stocks in there seemed like picks that were a little bit out of my comfort zone and familiarity. And when a main value of investing is holding for the long term, each company that's in this portfolio really needs to be something that I truly believe in for the long term. Now, the average return of the stocks that were cut was roughly around 10%. We're talking about names like Onset Medical, Berry Global Group. For the Canadian side, we had Quarterhill and Real Matters. And actually for Berry Global Group, which I did a video on a little while back, I still think that it is a winner. If we review this company 5 to 10 years down the road, I do think that it will be producing pretty decent returns. And so it's unfortunate that it needs to be cut. But when I think about Berry Global Group, and I did mention during that video that, it's a boring company, but in a good way. It's just not something that I'm truly excited about. And one of the values that I have when constructing a portfolio is making sure that the portfolio is a representation of how you see the world in the future. So is plastics and packaging really what I want to see in the future? Not really. It would be much more ideal if there was a way to make it a lot more environmentally sustainable, and there's companies out there that are actually taking plastic and turning it into energy. And those are more the type of companies that, they're innovative, they're disruptive, they are making the world a better place, or a greener place at least, while at it. And those are the more, style and types of companies that I would like to put the money towards. So a couple things that were added. Roku was one. And I did actually finally add Tesla. Is it overvalued? I think so. But I think that I have continued to miss out on the growth of Tesla, regardless of thinking that it's overvalued every single time. And so does it fit my values of where I want the world to be? Absolutely it does. And I think that autonomous vehicles and artificial intelligence that Tesla is working on will be a staple of the future. So even though it is overvalued, and I think it's significantly overvalued, to have a starter position is worth it, because it's gone up so much, and it did pull back from its highs of $900. So it's trading at, roughly a 10-15% discount since then. And for a starter position, I'm willing to take the risk, even if it drops down another 20-30% from here. At least I'll have initiated a starter position, and if it does, and I actually think that it's better valued from there on, then it's easier to just start pouring more money into it. The CoinFlip USD hasn't seen too many changes. I added a couple more shares into Palantir Technologies. We got rid of Onset Medical, like I talked about. And so this is kind of where the portfolio currently stands for the CoinFlip US side of things. The Canadian one is where a bit more changes happened. We added a healthcare company and actually a grocery Alimentation Couche-Tard doesn't actually have any groceries yet. They tried to make a bid in France. They have convenience stores that they're known for. And this is a company that's growing very slowly, but very steadily. And for a long-term hold, I think it'll be all right. We also added Constellation Software and Shopify, which I've always liked Shopify. I've had it in the US portfolio. I've moved it over to the Canadian portfolio just to get rid of the currency exchange. And speaking of the portfolio, we should talk about the stock market as a whole. Lots of people seem to think that the stock market is in a bubble and that the companies are extremely overvalued. To add on to this, there's been a lot of chatter that signs of it being in a bubble are usually when people start getting FOMO and piling onto speculative assets. These speculative assets are stuff like the meme stocks we saw a couple weeks ago with GameStop, AMC, Nokia. And there's quite a few articles of how many retail investors started getting FOMO, and they then started putting money into these, quote unquote, get rich quick stocks, right? There's a story actually here about a 25-year-old security guard who took out a $20,000 loan to buy GameStop. Stories like this are fuel for the fire, right? people see these stories and it's extremely sad, no doubt. This gentleman, he took out his $20,000 loan. Looks like here he was originally frugal, and he at least has index funds, right? So he understands that investing is important to beat inflation, and he's been doing it for a while, it looks like, to get up to $50,000. But people get this fear of missing out when they hear these stocks that are just shooting through the roof, and unfortunately for some, it's a very expensive lesson to learn. His story here is not the only story, and if you browse Wall Street Bets, or if you browse TikTok, there's many posts and videos of people posting their losses, and some are in the 6 or 7 digits, right? Those are quite expensive lessons to learn. But, at least for this gentleman here, he's still young. He's only 25 years old. He's got a lot of time to make that back. And, he said that he's holding, right? So he bought GameStop shares at an average price of $234. It has fallen around 80%. And like everyone else who was believing the hype, he really wanted it to go to $1,000. And so these, while painful lessons, at least for this gentleman here, he's got a way to get out of it. And, if nothing else, hopefully stories like these just help people learn more about financial literacy, right? You don't have to get into these, crazy speculative stocks like what we just talked about, BlackBerry, GameStop, AMC. You don't have to get into those to set yourself up well for retirement. We even played around with the compounding interest calculator just earlier on in the video. Even if you only get 8%, you're retiring a millionaire if you put in $100,000 now. And that was with no money added. So you start small, right? Start with $1,000 here. You put a little bit in maybe every quarter, and it starts building and building and building, and it compounds up. Even the portfolio that we have, right? This was started only in, the middle of December, and the returns have been pretty good. These are real dollars that if I were to sell everything right now, that is money in the pockets. So there's no need to go over speculative assets like that. Pick good companies that you believe in long term. Pick companies that will, help you build the world that you want to live in 20, 30 years from now, and put that money to work over there. On a risk-adjusted basis, you're 95% of the time going to do much better off. And yes, there are going to be those guys that probably make a killing, make 1,000%, and maybe they can retire overnight. But that's not investing. That's gambling. And if you want to do that, you can also just go to the casino and put it all on black. And to be clear, there's nothing wrong with if you've got a little bit of extra change and you want to speculate on something, by all means, right? But to do something like what this gentleman did, or to put your RSP money and your life savings into something like this and trying to get rich quick, it's a really tough path. And I hope that most people or more people can just take the balanced and less risky approach, so that when they need that money for either retirement or whatever their purpose may be, that they actually have it. So this video is going to be much more of a short and sweet one. It's more of just a PSA to, once you have your portfolio, and I will actually make a video on kind of the principles that I have when building a portfolio. But once you've got it, stick with it. Make sure it's something you believe in, so that you can feel connected to it, and that you can feel, proud of your portfolio. And stay away, at least if you're talking about, the bulk of your holdings, stay away from the speculative assets. I myself have holdings in speculative assets like Bitcoin right now. It makes up a very small part of my net worth, maybe 1 or 2 or 3%. But that's money that I can afford to lose, right? So if you're going to do anything like that, keep it very low. For the majority of things, have your plan, stick with it, build on that compounding interest, that 8 to 10% every year, and you will be completely fine.